Hey gang, Mandla here at FX Link. Thank you for joining us on this week's episode of the Trade Review, where we give you a weekly dose of insight on trading psychology, money management, and technical analysis. So in this week's video, we are going to discuss on the topic of when to bail out on your technical analysis and how to handle getting stopped out in the market. So without further ado, let's head to the charts. So, how will the market go to our anticipated take profit levels? Price could eventually shoot straight down, okay? Thus, you'd want to, if you are an aggressive trader, you might want to enter short as soon as the market opens, okay? As the market opens on Monday, enter short with stops higher than this high, probably at 43 pips, then targets over to these levels of structure in order for you not to miss out. If you're an aggressive trader, you might want to enter short as soon as the market opens, okay, with a risk to reward of 90 pips worth of reward and a 43 pip worth of risk, which is a 1:2 trade risk to reward. Okay, if you are a conservative trader, I personally will be looking for a double top within that larger double top that we had from here to this level right here. Okay, so I'll be looking for something like this, at least a touch at our bodies right here, and I'll be entering short. Okay, I'll be entering short in anticipation of a retest of these lows right here, and a stop loss of 11 pips. Let me go here, and a stop loss of 20 pips, 21 pips worth of risk on this one, and a 54 pip worth of reward on this one, which would be my first targets right at these levels of structure. Okay, then if I wish to take extended targets, I would take extended targets back at these structure levels right here. I'll be shooting for 106 targets at 94.34 levels right here, which would give me a 1:5 risk to reward on this one. So if you take a look, let me take. Well, hey gang, as we are in the charts, this is what the market has unfolded throughout the week. And as you can see, we had two types of entry techniques, where an aggressive trader could actually place a limit order when the market opens and actually sit through the market, right? Or we could have had another chance of waiting for another confirmation, which is a retest of this high right here, which we actually got. Let me take this off. Okay, we wanted to get a retest of these highs right here, which we actually got right there. As you seen on the video back, we had a double top. If you see clearly, we were overbought, and on this one we barely get overbought. So as I zoom in on my RSI, you see clearly we have a bearish divergence right here, which made a valid entry for me to hop on to the market, which is I hopped on with this particular risk to reward. The market ended up giving us a rally down right here, almost hit our first targets. If we could have hit our first targets according to my rules, I would have broken even on this particular trade. But since we didn't hit our first targets, I had to see through this trade and watch it unfold. And what happened throughout the week is that price went up again, retested these highs, gave us a lower high, then stopped us out. All right, and then stopped us out right here, only to unfold to be something like this with a lower close, and we are well reaching our targets, would have been targets in this case, which is a target of 106 pips. But unfortunately on this particular trade I was stopped out. The market throughout this week was kind of like a battle with Mike Tyson, you know. You get up, get hit, bam, get up, get hit, bam, with many blows. And that's the reality of trading, guys. That's the reality of trading. If you know throughout your back testing you have a 60% chance of being right than being wrong, then you have to account for the 40% chance of being wrong, and you have to expect it rather. And that is not a negative mindset to have. Actually, that's a realistic mindset that many traders don't possess in the market. Okay, let's go to pound CAD pair, and let's see what happened throughout that the week.
So this could be the first level that we're looking for as a second extended take profit. And for entry reasons, I could be looking at this area for an extension, pardon me, for a retracement. If I could trade my retracement tool from this area, from my X right up to my A, you can see that right at this area, as you try to narrow this level down, this is where we get at 382. Okay, so just right above where we have a completion of our box, this is where we get at 382 retracement. So in this case, I'll be looking for price action to at least give me a retracement somewhere back to this area, and we'll be looking for more confirmations. Possibly if we could get a bullish divergence or a double bottom, this could give us a more reason for entry, and from there we'll be expecting a continuation from price back up to this level. Now, taking a look at our RSI, you can see that at this case we have a bearish divergence from this upper high down. You can see that our RSI is giving us a slope to the downside, whereas price action is giving us an opposite. Now this could be the bearish divergence, which might be adequate for us to give us this push to the downside. We might take price a little lower in order to trigger our entry right here at about 382. And if this is the case, we could try to add another extension tool from this X to A, and right here back to X. As you can see, guys, we have a major cluster of 1618. Right back at this A, we have a 1618. So we have three clusters of a 1618. So this could be the second take profit level, and our trade might look something like this. Okay, entry might be somewhere at this area. Stop loss would have to be a few pips below our lowest low, where we're looking at a 32 pip stop. So 10 to 5 pips below, you could be looking at a possible 40 pip stop loss. And for the first take profit, you could be looking at a retest of structure back at this area, where this could be a trade of a risk of 40 pips for a total take profit of 75 pips. And if you're looking for extended targets, you could be looking back at this 1618 cluster, where in total you could be looking at another additional 167 pips. So this is what I wanted to share with you guys. Try to keep it short and simple without trying to confuse anyone. And if you're looking for extended targets, then you are looking to ride this trend way up to the completion right here at our major resistance area. Let me try to remove this. You could be looking to ride trend way up to this major resistance area, but I for one will be comfortable with trading the first take profits back at this retest of structure. And if other further confirmations give me a confidence that price action will be looking to extend up, then I'll be looking for another additional take profits at 1618. So thank you for staying tuned with us this week, see you again next week Friday for our market review. And please don't forget to subscribe on the YouTube channel. Hope you enjoyed, and I'll see you again. Peace.
All right. Okay. As you see on the video, my partner identified. It's quite clear. If you have been with us for quite a while right here, you would have known how to read the market. The Dow theory of higher highs, higher lows, higher highs, higher lows, or lower low, lower lows, to identify a particular trend. In this case, we have a series of higher highs, higher lows, higher high, higher lows, higher high, higher lows on our top-down analysis, which gives us a indication of a trend continuation from the upside. And as you have seen on the video, my partner particularly looked for a retracement because the market was something like this. It went high right here and it was higher before unfolding to extend, as you would see. Okay, we looked for a retracement back at these lows right here with a particular risk to reward of if I remember 40 pips. Okay, and potential first target of 80 to 90 pip worth of reward on this one. Okay, then if you would have taken extended targets on this one, you would have looked for from this particular low to this particular high, if I'm not mistaken. You would have looked for a potential target of 170 pips, which is more, which would give you a 1:3 risk, 3.8 risk to reward, which is a huge risk to reward in this case. Okay, so what happened throughout the week? Unfortunately, price didn't give us a retracement as we hoped for. Okay, and what did price do? Price eventually extended without giving us a retracement. Okay, so I would like to challenge you for a bit and ask you, what would you do in this case? Would you wait for a retracement? Okay, like a retracement back into structure for a potential buying opportunity yet again, or would you buy? Would you look for a kill zone again right here in order for you to buy yet again right here? Maybe narrow down your kill zone right here, or would you bail out on the analysis and leave it as it is? Mainly as price moves in my direction. Let's go to a clearer screen. Okay, so let's say you have a potential opportunity to buy, to get long into the market, and you have a particular kill zone right from this. Okay, your rule says, okay, I have a potential buying opportunity as soon as price retraces back into these levels of structure. Okay, right? And price is right here. So you say, if price does get right here, okay, I will be looking for, okay, you will be looking to buy in this case right here. All right, so let's say everything aligns at this level. You have a Fibonacci cluster at that level. Everything you particularly want to make a valid setup in the market is between these levels, and price hasn't yet hit these levels, and you would anticipate a particular risk to reward of in this case 55 pips, and a potential reward of 104 pips, which would give us a 1:1.8 risk to reward, and which is not too bad. Okay, you say, okay, now if price does get here, I'll be buying. All right, now then then the market unfolds and does this. Okay, continues probably a little bit lower right here, and then shoots up to your target levels. Okay, so after price shoots up to your target levels, what would you do if price action then does this? Would you still then look for a buying opportunity, or would you let it slide? Right? What would you do? Personally, I would be looking for a valid setup, because a valid buy is a valid buy is a valid buy. Okay? In order for you to keep up your consistency in the market, you have to enter into a trade that will give you a valid setup, whether you like it or not, because you might hit a loser, and after two losers, then you might feel some sense of fear and not trying to get in, because it doesn't feel right, and you don't feel like you want to actually buy into the market, and then you find yourself missing an opportunity of another extension or another retest of these highs. All right, okay, now in this particular situation, this is what happened to the market. Price went up, came back to a particular kill zone. Okay, came back to these levels of structure, which is right here. But if you could look at our RSI, we haven't yet been oversold. So this would have, in my case, this would have not been a valid buying opportunity, and I would let it slide, because many of my crucial indicators indicating a buying opportunity are not met in this case. All right, now let's talk about the pain of losing a trade. Okay, many traders need to accept the losses they incur from the market. Period. You need to accept the losses that you get from the market, because as we all know, there's no strategy that is 100% correct. Would you agree? There's no strategy that is 100% correct. Thus, you have to account for those losses. When you lose your trades, you have to take your medicine and move on. Take your medicine just like everybody else. Everybody else loses in the market. The difference between professional traders and amateurs or beginning traders is that professional traders understand that losses will happen, and in order for you to not fall prey to many psychological biases, is by simply minimizing your losses. Okay, and we know that in our subconscious mind, before you have entered into this game of trading, in your subconscious mind, you know that losses are associated with being bad, right? It is kind of like chess. Whenever we went to a chess tournament, we had a mantra which said, losers accept losses and winners are relentless. So whenever we lost a game, especially when we are playing as a team, whenever we lost a game, we felt bad, thus associating losing as bad. And that would often block our mind to expanding and growing, which is the greatest thing ever you can ever do as a human being, which is lose in something, because that's an opportunity to grow. But we never saw it as that. We saw losses as an indication that we are losers, not an indication that we have an opportunity to grow. So whenever you lose in this particular game of trading, many traders feel bad, but professional traders don't act upon the feeling, the emotion of loss. The trick is manage your risk and make sure you minimize your losses. So the first step to advancing in trading is actually accepting that profits and losses come and go. Losses are an inevitable part of trading, and you cannot improve your trades or become a consistently profitable trader if you can't accept it. Then if you cannot accept that, then maybe trading is not for you. You should be always, another thing is, you should be always committed to your trading. Even during the lowest periods, especially when you go through a drawdown. I remember quite well when my partner and I had gone through a drawdown of actually 9 trades in the row. We were like, we suck, man. We suck. Is trading for us, right? But we stuck through it, and we ended up in a profitable side of the market. So even during the lowest periods, it is essential to remain committed to your trade. Process over outcome. Love everything about the entire process, including the losses.